Just weeks after soaring to an all-time high, Bitcoin has come back, crashing down, wiping out the more than 30% gain it had racked up for the year. It is a stark symbol of the risk-off wave sweeping through global markets as the once high-flying tech sector cools and investors brace for uncertainty. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. U.S. economic data and earnings from AI bellwether NVIDIA expected to shape the market narrative this week as lofty equity valuations come under investor scrutiny. Geopolitics add to the woes with some of Japan's biggest tourism and retail-related stocks slumping as Beijing warns its citizens of traveling to and studying in the country. We'll discuss how investors should navigate the risks with Citi Wealth CIO Kate Moore and find out why she isn't worried about current valuations. We'll also speak exclusively with Bain Capital's co-managing partner John Connaughton on why Asia is now the hotspot for private equity. Plus, we'll have the CEO of Indian payments tech company Pine Labs fresh off a listing that sent shares surging despite worries over valuation. Global markets are grappling with rising fears over high valuations across sectors, especially around AI and the uncertainty in the Fed outlook. Don't forget, NVIDIA's earnings are also coming this week. Meanwhile, fresh geopolitical tensions in Asia add to the worry list. Japanese consumer stocks are dropping after Beijing warned its citizens of a travel and study in Japan amid a deepening diplomatic spat between the two nations. For more details, let's bring in our China correspondent Min Min Lo in Hong Kong. Also tracking developments in Japanese markets, our stocks reporter Alice French. Min, let's start with you. Talk us through the actions Beijing has taken so far.
Yes, the latest news that we got today out of Japanese media is that Japan is sending officials to China today to discuss this spat and to hopefully de-escalate. But China so far has taken a series of actions. It had told its students in Japan to monitor the situation. It has issued a travel advisory advising citizens not to go to Japan. And you can see the MOFA advisory here. It's also dragging out all the other instances of crimes and attacks of Chinese citizens earlier in the year, adding that to the list of security concerns for Chinese citizens. And the impact here is huge, right? You were checking some of those stocks in Japan today. Some of the big retailers, the likes of Shiseido, are seeing nearly 10% drop. And that's because some of these brands like Shiseido, they rely on about 30% or more of their market revenue from the Chinese market. And so far, Japan has been urging for calm, saying that their stance hasn't changed and that more dialogue is needed, but we'll be monitoring the situation closely.
Is there a sense that this is a signal of more countermeasures to come from both sides?
Well, we did see further escalation over the weekend with China sending 4 armed naval patrol ships to the disputed waters around what Japan calls the Senkaku Islands and what China calls the Diaoyu Island. And, you know, China saying that that was a rights enforcing patrol that has a legal basis. And here you can see the People's Daily really warning that this was the strongest and most overt threat of force that Japan has given to China since World War II, because Takaichi's comments essentially gives legal justification for Japan to intervene militarily in the conflict with Taiwan, and Global Times as well saying that this is equivalent to military adventurism and repeating the mistakes that they made during World War II. So really bold sort of rhetoric coming from China, and Chinese a Weibo account linked to Chinese state media also signaling that some of these actions that China has taken so far is a signal of more countermeasures to come.
And Alice, it seems like trepidation in the markets, as we heard from Min, Japanese tourism and retail stocks slumping on the news. Which names stand out? And, you know, why are we seeing such a dramatic response to the news?
Yeah, it's a good question. I mean, as Min mentioned, Shiseido down around 11% this morning. So, we know that they get a big chunk of their revenue from China. But even more so being hit this morning were companies that really rely on tourist revenue for their profits. So things like department stores, for example, we've seen Isetan Mitsukoshi down around 12%. Things like Oriental Land, who run Tokyo Disneyland, also having a bad morning. Companies like Pan Pacific that run Don Quixote, of course, that very popular tourist retail shop, all having a negative morning. And this is basically on expectations that, if this spat does continue to play out and we do see a fall in inbound travelers from China, this is really going to hit those retail names and those tourism names. We're seeing a few sort of hotels down as well this morning. Airlines also not having a good time. And we did have a note out this morning from Nomura suggesting that if Chinese travelers did go down to zero, which would obviously be very extreme, but perhaps not completely out of the question, it could have an over 200 billion yen hit on the Japanese economy, which obviously is pretty huge and could also even have implications for things like the Bank of Japan. We know that Chinese travelers are among the biggest spenders when it comes to tourists in Japan, making up almost 30% of tourist spending in the last quarter. And so I think, there's a lot of concerns among investors here and analysts this morning about how this will actually play out in terms of companies' top lines. And at least sentiment-wise, I think we'll probably see this play out sort of in the coming days and throughout the week until we do get some sort of calming in the spat that's playing out before our eyes.
You got to wonder whether this has to do with the froth in the market as well.
Yeah, absolutely. I mean, as is the case worldwide, Japan's benchmarks have been up at record highs in recent months. And I think certainly, companies like department stores, for example, have been doing pretty well. There was quite a lot of optimism around kind of tourism-led growth towards the beginning of the year. A lot of companies kind of hitting even record highs this year. And so I do think there's definitely a little bit of profit taking happening. But certainly the concerns feel real among investors this morning.
Alice, thank you so much for that. Japan stocks reporter Alice French in Tokyo and our China correspondent Min Lau coming to us from Hong Kong. Let's get perspective from Kate Moore, Chief Investment Officer at Citi Wealth. Kate, it does seem like suddenly geopolitics rearing its ugly head yet again.
Yeah, well, Haslinda, here's the problem. We've had so many spats of geopolitical risk over the course of 2025 and even over the last couple years that investors are asking themselves, should they fade this risk and this pricing in the market? And unfortunately, history shows us that they probably should. That we have, bad news, particularly on the geopolitical side, factor into overall market prices. It causes declines, particularly, and I'm sure we're going to get to this, when sentiment is a little bit worried at this moment. And over just usually a couple of trading days, sometimes it's a week or two, the risk ends up coming out of the overall market. So I understand the market's response, although I would say history tells us that these market responses to geopolitical events tend to be relatively short-lived.
We talk about froth, we talk about valuations. You're not concerned. Why is that?
Okay, so it's not that I have no concern around valuation. I'm certainly aware of valuations, and I think a lot about where multiples are, relative from one asset to another at this point in time. But also, I'm conscious of comparing valuations to history. And I'll tell you why. When people look at historical multiples for whether it's the U.S. equity market or the Chinese equity market or the European equity market, they're not comparing apples to apples. They're comparing a very different set of companies with different balance sheets, different market cap and sectoral composition of the index with today. And I think what you need to do is ask yourself, with the information we have available and with the market composition and the balance sheets and the business models, does this feel right on a relative basis to every other opportunity at this point in time in the market? So I'm aware of multiples. I understand that people are uncomfortable and that sometimes they get anchored to lower numbers based on their investment history. But if the multiples are higher because we have better visibility into earnings, better visibility into free cash flow generation, where we better understand the business models, the management teams are communicating with us, that doesn't worry me as much.
In terms of momentum, of course, we've seen a lot of it, and people tend to think that this momentum will go on forever.
Yeah.
Is there a belief that perhaps, given the liquidity, the world is sloshing around with cash, that momentum will persist, even though we're seeing these bouts of volatility?
Yeah, I mean, this is a good question. Look, I will say pullbacks periodically throughout the year are very healthy. They're also the rule, not the exception. And the couple times that we have seen no pullbacks in a given year tend to come after a year where there was a huge drawdown. So after the 2022 market performance, 2023 had no drawdowns. But a few pullbacks throughout each quarter is normal and healthy for the functioning of markets. The one question I keep on asking myself and actually asking my colleagues and my peers on the street and our clients is, how big of a pullback could we really sustain? Because to your point, there is a lot of cash and a lot of capital on the sidelines. In the past, we would say we could have a consolidation period of 5 to 7%, but there are so many people who have the fear of missing out, who are sitting on large cash balances. This is true of a lot of Citi's clients, and are looking at some of these very high quality assets and saying, I want to get in at a little bit of a lower price, but I'm not going to wait until there's a massive gap down. So I think that these pullbacks become smaller in magnitude given the amount of cash.
So buy the dip, but not yet. What are you waiting for? I mean, what are the indications before dipping your toes back in?
Oh my, I have to say, the buy the dip mentality, sometimes I want to pretend like it's going to, we're going to go move past that. But unfortunately, over the course of 2025, we've proven once again that this psychology is so ingrained in investors around the globe.
That's why it's been well supported.
It's been well supported. But I will say, when we do have these pullbacks, we have to be really focused on high quality, sustainable earnings growth in the equity market. We don't just buy lower quality stuff that has pulled back for no reason. Or as I like to say, we don't rotate in the market just for rotation's sake. There has to be a fundamental driver to it. So if there's broad-based selling in high-quality names, particularly, as I was saying, these sectors, industries, and companies that we believe are going to be able to sustain their earnings growth through all parts of an economic cycle, then we say, okay, that might be a time to, add a little bit to positions. But we want to be selective. Where we recognize we're not at the beginning of the cycle, probably not even at the middle of the cycle. We're in kind of the latter half of a cycle from a both business and market cycle perspective, and quality and fundamentals matter.
Before we take a look at what you should be picking up, considering the better quality names, as you say, what are the indications that would suggest that a correction might have legs? It could be deeper than you think.
Okay, so one of the things I'm really fixated on is how the market is thinking about future Fed moves and Fed cuts and the impact that policy might have on both market leadership as well as the economy. So we saw over the course of October a number of sectors and industries and trades that are very rate sensitive outperform, particularly as investors were expecting the Fed to cut policy rates at every meeting forever and ever and ever. And what we've actually seen is that the data is coming in a little bit less favorable for sustained cuts at every single meeting, and that many of the Fed speakers that spoke after the October Fed meeting were indicating that it was a much tougher call to make that 25 basis point cut than perhaps even just the paper or the statement would suggest. And so we've seen some of that kind of back off. Here's what I would say. I think people who are betting on low inflation or at least lower inflation than today for the next couple quarters, and who are betting on a policy backdrop that is incredibly accommodative, may find themselves disappointed. And this is where, again, going into the high-quality, sustainable earners is really, really important, and away from the small caps in the U.S., the home builders, and the rate sensitives.
So therein lies the issue for me, and the reason why I asked the question. Two things have driven the rally. Expectations of deeper rate cuts and also the AI play. Now we're seeing a bit of an unraveling in a way of both factors.
Both of those, yes.
So what gives?
Absolutely. Okay, so just back to the rate thing here. The Fed, as we know, has a dual mandate: labor and kind of full employment, and as well as containing inflation. We have now been way above the Fed's inflation target for 4 years. It's over 54 months at this point. It's an uncomfortable level to say that this is my target and I'm nowhere close to it for 4 years. And the labor market, I think the U.S. labor market is frozen, but not massively deteriorating. You're seeing companies hold off on hiring for a multitude of reasons. Number one, economic uncertainty caused by the tariffs and what may be, and I'm not a legal expert on this one, the overturning of the IEEPA tariffs, which of course changes the assumptions they need to make about capital expenditure and investment. The second, of course, is like the business model use of AI. We're starting to see use cases come up, and a few companies highlight these opportunities, but they don't quite know yet what the impact is going to be on their labor force. So rather than hiring or firing everyone, let's just kind of hold things steady. And I'd say the third thing is what we were talking about a moment ago, is the duration of the business cycle. So it's been quite long in the tooth. So people are just, management are just waiting a little bit for more information. So this economic uncertainty from policy and the AI and the duration of the cycle is leading to a freezing of the labor market at a time where inflation is actually picking up. So I think the Fed has a very difficult decision in December, and expectations the market has had that monetary policy would drive another wave of liquidity, I think should be challenged.
And AI, what do you do with that? Do you buy the dip as well? I mean, and how important is NVIDIA's earnings this week?
I think NVIDIA's earnings is very, very important.
Make or break moment for?
I think it is. I don't think it's a make or break moment. It is generally a support the existing positioning moment. And
so it could revive a rally.
Yeah, and without speaking specifically to NVIDIA, let me just say this. Most companies offer up guidance they know they can beat. The penalty for missing guidance, whether it's on sales or on earnings, is so great these days, and especially for well-hold stocks like some of the AI companies and the hyperscalers, that I think management teams are actually giving us numbers they know that they can beat. So I'm going to be watching not just what happens with earnings, but what happens with future guidance and how that causes the analyst community to readjust their expectations. I think it's very important from a sentiment perspective when so many people own an individual security, and it's a huge part of major indices. And it's also the most important and durable theme in the market at the moment. But everything we've seen so far in earnings season supports the idea that companies are spending more, not less, that they are continuing to find real use cases, not just in the tech side, but in all the different industries. And I know it's uncomfortable for most investors, but I do believe this theme is durable. I would look for pullbacks as an opportunity to re-up in this specific theme, because I think investing in AI and the spend around it is existential.
So even as you look to reinvest in the AI theme, you may not necessarily be looking at the Mag 7.
That's right.
And it may not necessarily be in the US either. Talk to us about the strategy you're thinking.
Yeah, so actually investing in AI and technology is underpins a lot of our constructive view on emerging markets, Asia equities as well. We have an overweight to that in our portfolios, and we had added some to China, actually, over the course of the summer. That's done very well for us. But it has not been a bet on the Chinese economy. In many cases, we're not also betting on the EM Asia economies broadly, but instead on what companies are in these indices, and that they are high growers, geared to this enduring theme, and frankly, that we want to have a geographically diverse strategy for investing in this theme. We want to own the Asian companies as well as the U.S. and Western companies, and take a multi-pronged approach, because there's going to be an amazing amount of innovation and investment in both areas.
So Chinese AI plays are still compelling versus the U.S. based on valuations?
Well, valuations, as we know for these names, are meaningfully less than their U.S. counterparts. But there have been some policy and, political headwinds that have kind of held back the re-rating of these names, as we've seen in the U.S. What I will say is we do know the Chinese government is supportive of this overall space. I think that policy support, explicit and implicit, is incredibly important. And it's what's getting more international investors comfortable with taking more risk in the region. As you know, there was a long narrative of China being uninvestable from global investors. And people were really worried that they were going to get off sides and have concentrated positions that were out of favor for one policy reason or another. I think that's starting to thaw. I think that freeze is starting to thaw over the course of 25. We've seen positive flows and many more constructive conversations about adding, because some of these companies in Asia are best in class.
Can you draw that distinction that you're investing in Chinese AI, not the economy?
That's right.
But they're interlinked. And so far, data out of China has been pretty lackluster. In fact, when it comes to investments, it's the lowest we've seen in a very long time. Surely that's there is a cause for concern.
Yeah, and this, look, I would be more worried if half of the equity market in China, for example, didn't have a market cap that was geared towards technology. If I was buying the broader economy, I would be concerned. But honestly, I could make the same argument you're just making around the U.S. There are plenty of areas of weakness, particularly in big parts of the consumer.
And growth has been pretty resilient, whereas China is trying to revive its economy.
Growth has been resilient, but I'd say
US.
There's a big difference between the headline and the reality, right? Many of the sort of headline, kind of aggregate numbers for the U.S. economy and from consumption are really kind of telling a story of the upper 20% of households from income, or a certain set of companies that have been reinvesting. Many others, in fact, have seen more margin compression, whether it's from tariffs or from kind of more broad-based inflation. Many others are kind of struggling to continue to put up strong earnings numbers, but the aggregate data looks good because of the concentration of these sectors, technology adjacent in the index. It's uncomfortable, but the market and the economy are very different in both the U.S. and China. That leads to opportunities.
So resilience in the Chinese market, that means resilience in the EM space as well. How are you looking at it? They say it's slightly different for EMs this time around. That's greater depth, for instance, and so it is a way to go, and they may just outperform.
Yeah, well, look, it does feel different, and you may know, but I spent the first half of my career as a dedicated emerging markets investor, so it's kind of near and dear to my heart. I think it's a great place for people to concentrate some of their work because you learn so much about the interplay of the macro and the micro and bringing these things together. We've become a little bit more constructive on Brazil, actually, related in part to the AI trade and the resources required in order to power up the AI trade. And of course, Brazil has a large concentration of some of these resources. So I think there are other places, around the emerging markets that are also going to be in this secular theme. But we want to be cautious and understand, again, that we're not at the beginning part of the economic cycle for any place. So buying everything without being conscious of the fundamentals is not a great strategy.
The dollar has been pretty resilient. That's a negative for emerging markets mainly.
Yeah.
Especially for Asia, yes?
The dollar's been resilient very recently, right? But we know it's been
Well, with the Fed expected to kind of taper, its aggressive stance on rate cuts, that could continue to be, a factor for dollar strength.
Yeah, well, medium term, I'm really focused on fiscal sustainability in the U.S. And I have to say, we're not seeing much out of this administration to suggest we're going to be in a better position 2 or 3 years later, and while we may have stability in the dollar in the very near term, my strong view is that we're likely to have a much weaker dollar over the course of the next 3 to 5 years, and that we're going to see a lot of investors try and position for that. It may not be rushing out of dollars in the fourth quarter of 2025 or in the first quarter of 2026, but diversifying their assets, I think, is going to be really, really important strategy.
Kate, it's been great having you with us. Do come back soon.
So much.
Kate Moore, Chief Investment Officer at Citi Wealth. Now, still ahead this hour, we'll be joined by Bain Capital's co-managing partner, John Connaughton, for an exclusive interview as private equity sharpens its appetite for Asia. Keep it here with us. This is Bloomberg. Welcome back to Insight. Here are some of the top corporate stories we're following. A McKinsey review has reportedly criticized ANZ's culture, saying staff avoided delivering bad news. The AFR says the review also found that former CEO Shane Elliott did not sufficiently focus on customers and non-financial risk. ANZ hired the consulting firm to conduct a wide-ranging review after Australia's banking regulator found shortcomings and imposed higher capital requirements. Boeing says it will focus on stabilizing 737 production at 42 planes a month before increasing output again next year. The company is still recovering from years of setbacks and working towards certification of the smallest and largest 737 variants. Boeing says getting it right at pace is better than going fast as it ramps up both the 737 and 787 lines. Well, still to come, we're joined by Bain Capital to discuss Asia's private equity opportunities, from carve-outs to cross-border deals. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. We're tracking declines across mainland China and Hong Kong markets on fresh political tensions between Beijing and Tokyo. China's officials warning citizens against traveling to and studying in Japan after comments from Japanese Prime Minister Sanae Takaichi over possible military force used in any potential conflict over Taiwan. Chinese travel stocks sliding on the news. Top Chinese airlines are waiving cancellation fees for flights to Japan in response to the government's travel advisory. Air China, China Southern also currently in focus. Of course, China back from that lunch break. We have those stocks under a lot of pressure as we speak. Trip.com also leading the pack lower, currently down about 5%. We know that in terms of Japan, it is set to send a senior diplomat to China in a bid to soothe tensions, according to public broadcaster NHK. Tensions between Japan and China have risen since Japanese Prime Minister Takaichi said military force could be used. And in terms of Japanese retail shares as they come back from that lunch break in Tokyo, this is how it's looking. No reprieve for Shiseido, down about 9%. And we have Isetan Mitsukoshi slumping almost 11% right now. And early today, Don Quixote chain operator Pan Pacific International fell as well. Now, 4 of South Korea's biggest conglomerates have pledged to invest about $550 billion in the country over the next 5 years. The announcement came after leaders of Samsung, Hyundai Motor, LG Group and SK Group met with President Lee Jae-myung, who urged them to expand domestic investment following a trade deal with the U.S. The investments will encompass AI infrastructure, research and development, chips, energy, and biotech. And Swedish buyout firm EQT says it's aiming to triple its Asia investments to as much as $110 billion over the next 5 years. That would outpace the firm's deployment in its home turf of Europe. The firm has returned 25 billion euros to its investors in the past 12 months, with Asia accounting for a sizable percentage of those exits. Chairman Jean-Eric Salata told us recently how they're capitalizing on global investors' shift out of the U.S.
Since the tariff announcements, is that people have been looking at their concentration in their portfolios in the U.S. and thinking that they're not diversified enough. And so people have been looking to Europe and to Asia as a way to diversify. And that's driving more flows into the region, which, as you say, is elevating valuations. I mean, you look at the stock market performance this year in Hong Kong, in Japan, in Korea, which is one of the top performing markets in the world. Who would have guessed?
Well, Bain Capital is a global private investment firm managing approximately $185 billion in assets. Joining us exclusively, John Connaughton, co-managing partner at Bain Capital. John, good to have you with us. So it does seem like capital is shifting to Asia away from the U.S. Is that what you're seeing as well?
It certainly has, for frankly the last decade, been a growing market for us. I do think there has been a rotation of interest, but I still feel the demand for investment in the U.S. remains fairly strong. We've also seen a pickup, frankly, in Europe, which has been also a terrific tailwind for us, given we're a global business with funds in each of those 3 continents.
So where does Asia stand then in relation to the U.S. and Europe? You seem to be quite excited about those 2 markets.
Well, I think, Asia, we're celebrating our 20th year in Asia. And actually, as it started out, ironically, it was mostly a China market and an India market. And those markets, early days, was more about asset selection. It was about growth. And it was about the trends and the secular trends of these emerging economies really coming onto the world stage. But we've seen a lot of evolution over the course of the last 2 decades since we've been in Asia. We've seen the emergence of Japan as a really core market for us. It's our second largest market after the U.S. And it really speaks to the development of not just growth equity and asset selection, but just the kind of private equity investing that we do. We're very much in the business of helping to partner with founders, partner with companies to carve out businesses. And for our markets, that's what's really developed to get us excited.
But in terms of your investments in Asia, I mean, Are you wanting to double it, triple it? We heard from EQT just slightly earlier, it's tripling its investments in this part of the world.
Well, even just 5 years ago, we were managing about a $5 billion fund for Asia. I think the combination of our current funds plus our global funds, I think we're going to be doubling our investment across Asia over the last 5 years. And on top of that, we've expanded into credit and special situations investments and also beginning to do some real estate investments. So the activity has not only gotten larger, but it's also broadened its scope in terms of our points of presence across Asia.
People talk about how there is now a convergence of the private and public market. What opportunities are you seeing on the back of that?
Well, I do think that markets will come and go. I think we saw the markets in China shut down a couple years ago. We saw the markets be quite volatile in the case of markets in India, which were really at very, very high valuations, but then have moderated. So oftentimes we're the choice of capital for people that want to enter into a longer-term partnership with our patient capital that looks through the cycles that exist, across all of the different economies in Asia, frankly, across the globe. And so we'll oftentimes come in before the IPO or at least a few years before they really want to take the crack at becoming a public company by being a private partner for those businesses, professionalize the business, try to put in management teams, oftentimes with a founder that needs a professional management team. And that crossover opportunity for us presents a huge opportunity, particularly here in Asia.
John, a lot of the conversations in the markets have revolved around how frothy the markets have become, not just in the public market, but also in the private market. In terms of private equity, do you see froth? How much froth is there?
Well, I've been doing this for a long time. I mean, there always does feel to be excess supply of capital for the supply of opportunities, and so that creates a lot of tension. But I would say relative to just a few years ago in 2021, where all markets across the globe were benefiting from quantitative easing, globalization, a lot of the markets having come out of COVID very strong. And so from the standpoint of where we are today, I think the fundamentals, are very strong. So you're coming in at a valuation that isn't as frothy as 20 and 21, but actually the fundamentals are a lot more certain than they were back in that period of time where we had the COVID dislocation.
And you talked about how Bain is investing in companies before the IPO. There are lots of concerns about exits and whether or not companies are staying private longer. So what's the strategy there? How are you looking at that?
I think our average hold period before we exit is oftentimes a lot longer than our competitive set. So we're very much interested in this 5, 6, 7 year timeline, not quick flipping of assets. So from our standpoint, being longer duration private investors provides a lot of value for us because we can compound our returns, we can actually build for the long term, and really the idea of getting liquidity isn't really required by our investors. Now, notwithstanding that, we've had an amazing 24 months where we've actually been over $25 billion of capital that we've returned to our investors. And that's across all of our private strategies. And that's juxtaposed with investments that are really around 12 to 13 billion. So frankly, a doubling of our liquidity versus what we've invested over that period of time. So our investors have been quite pleased with that. We've had public exits with Virgin Australia Airlines, Kyoshia in Japan. We've had trade sale exits. We've had recaps. So, it's been a fairly robust period of time for us, at least, over the last 24 months.
And speaking of Japan, what opportunities do you see there? We've seen lots of deals in Japan, big deals on the back of that as well. Is there a sense that people are moving away from the Chinese market and more into Japan right now?
Well, there certainly seems to be, for the last 5 years, a lot of interest in Japan. We've been there for 20 years, and we've done nearly 40 transactions in that market. So that market is really important to be good stewards of your reputation, to have great relationships with the banks. It's a very concentrated banking community. And you really have a long gestation for sourcing and building relationships with corporations to allow you to do carve-outs or to allow you to manage to build a relationship with a founder, to do a founder control transaction. So from our standpoint, having been there for over 2 decades, for having offices not just in Tokyo but Osaka, we have a fairly deep presence there that I think gives us a big advantage, independent of the competition. There are definitely more deals in that market than there ever been before, but they take a long time to accomplish, and you have to have those relationships to be able to execute, especially at scale.
And wouldn't you say that competition is heightening in Japan? I mean, if you take a look at Fujisoft, for instance, Bain lost out to KKR for that deal.
We're not going to win every deal, but our velocity, about half the capital that we've deployed in Japan has been, in competition. But a lot of it has been proprietary transactions where we've built a relationship. We did a deal recently with Mitsubishi where they had a pharmaceutical company, and we've been working with them for over 2 years to try to structure an opportunity to carve out their pharmaceutical pipeline. We have a terrific U.S. business where we really understand all the life sciences companies around the globe. So we were able to bring molecules into Japan, into a company that we bought as a carve-out to really build for the long term. That kind of complexity of cross-border, having the life sciences expertise, and then having the relationship with Mitsubishi, I think, is a huge advantage for us.
John, I want to take a look at exits in Japan as well. The numbers have been pretty clear. 87 IPOs, 97 delistings this year. How are you looking at exits in Japan?
Well, I think, we've had a combination of strategic sales. Oftentimes, when we've been able to operate a business for a while, build out its either global footprint or product expansion or distribution, at the back end of that, oftentimes strategics want to reemerge to purchase our businesses. And so I'd say a half of our transactions ultimately go back into a strategic exit environment. We take companies public, though. We obviously took Kyosho public, Skylark, a number of other tech companies. And so we're fairly active in both the public and private markets. And they've been very favorable to us. We've had all of our public companies trade up in a way that has been good for us and our monetization, but also good for the public shareholders who bought those stocks.
As you said earlier, this is a pretty hot space. There's a lot of capital flowing in and a lot of capital getting deployed, some say, in a hurry. Is there reason to be concerned about perhaps a lack of due diligence?
I don't think so. I believe that our competitive set that we see in Asia, particularly in Japan, I think have fairly robust platforms. I think we've been in the business, many of us, we've been 40 plus years. A lot of them have been 30, 40 years. So I don't think we'll be without mistakes, but I do think the rigor around diligence, I think, particularly in the Asia markets, is quite high. The U.S. markets and the developed markets oftentimes have a much more competitive intensity, I'd say, than the Asia markets.
John, we're counting down to the India Open. It's coming in about 3 minutes from now. The Indian market looks pretty expensive, don't you think?
It has been a little expensive, and particularly I think there was a lot of people investing behind the China Plus One. The markets rebounded significantly on the high growth that came out of the post-COVID period as China moderated, India took off. And with a lot of the sort of enthusiasm around the administration's reforms, I think a lot of money was really destined for India putting up prices. But that is moderated. moderated post-election with the economy slowing down and with some of the challenges of some of the foreign policy directions that have left some more uncertainty around the direction of trade. You have to become a little more selective, a little more disciplined on price. We've actually done a couple transactions this year in India, and I think we found those to be at attractive valuations for growth, but certainly more discipline is required in this somewhat more frothy market coming out of the last couple of years.
John, before we let you go, I'll be remiss not to ask you this question. We know that Costa Coffee is being sold by Coca-Cola. Any interest from Bain to make a bid on it?
We generally don't like to disclose our pipelines, but suffice to say, we look at everything that has an interest. We have a lot of consumer businesses we bought over the years, and so I can assure you that we've actually been active across any deal of scale in Asia, given our presence here.
John, thank you so much for playing along. John Connaughton, co-managing partner at Bain Capital. Thank you so much for your time today. Let's do a check on Indian markets. They are about to open momentarily. This is how it's looking in terms of pre-market. Let's flesh the numbers as we await that open. Of course, Asia under pressure as we count down to NVIDIA's earnings. It is expected to shape the market narrative. Investors will finally get fresh signals as well on the health of the U.S. economy as agencies begin releasing those key indicators, including the employment figures, and that's driving sentiment in Asia as a whole. India from the get-go showing some resilience. It is in a positive. The Sensex currently up about 0.1%. The other benchmarks also in the money as we speak. In terms of the Indian rupee, trading flat versus the USD 88.72 right now. Now, still to come, Google expected to boost its investment in southern India, and that's according to the Chief Minister of Andhra Pradesh. We'll hear from him next. Keep it here with us. This is Bloomberg. Welcome back. The leader of Andhra Pradesh, one of India's key southern states known for its thriving tech hubs, is confident that New Delhi and Washington will soon strike a trade deal. And Chandrababu Naidu, who has positioned his state as a major destination for investment and innovation, spoke to us about the ongoing trade talks and why he remains unconcerned about U.S. restrictions on H-1B skilled visas for Indian workers.
These are all always challenges, opportunities. When you don't have any production, no need to depend on global community. Today we are producing shrimp, aqua. National exports 60% are from Andhra Pradesh, 60-65%, 2/3 are from Andhra Pradesh. Naturally we will have this type of problems. One is alternative markets. With my strength, I have to move forward. And also they are negotiating Government of India. They may sort it out.
Do you expect a deal soon?
Very soon I'm expecting something.
There's a lot of students here too who are engineers and they get H-1B visas into the U.S. Those are now being restricted. How do you cope with that?
No, what I'm saying, in knowledge economy, location is not important. Knowledge is important, leadership is important. I can start a company here to service Americans cost effectively in a service sector. There are manufacturing, I have to go there. There are some sectors where physical presence is important, then they have to move. Otherwise, so many services you can provide online by having proper knowledge and leadership quality. That is going to happen. If all intelligent people are going to America. Because of that, they are doing the best. Now some people are returned in India. That will help us further.
And that was Chandrababu Naidu, Chief Minister of Andhra Pradesh, speaking with Bloomberg Asia Economics and Government Executive Editor Daniel Ten-Cate. Now, we will have more from that interview in just a few moments, including his comments on India's tech growth ambitions and plans for quantum computing. And And speaking of tech, India's top tech schools are seeing opportunity in President Trump's H-1B visa curbs as students rethink the traditional path of going to the U.S. to work. India's top engineers no longer see U.S. jobs as essential for success as growth prospects at home are reshaping career paths. For more, let's bring in our government reporter in South Asia, Swati Gupta. So, Swati, the sentiment has changed. The thinking has changed.
Yeah, very much so. The Indian Institute of Technology, it's a cohort of about 24 universities, and they are some of the most prestigious schools in India. And they have churned out the best engineers in this country, which are now running some of the biggest global companies. And traditionally, students have left India and they have gone to the US to work in big tech and build innovative, technology. But increasingly, there has been a drop now in the number of students who are going abroad from these universities, and as well as the growth of an ecosystem in India itself, which is encouraging all of these students to build their own startups. So most probably the visa curbs in the US and the constant policy changes will not affect the cream of India's engineering students.
And there is a sense as well that the H-1B visas may prompt Indians overseas to return home.
Well, India is hoping that that happens. The directors who are running universities here, the government, industry experts, they are all hoping that this moment that we are seeing with US policy changes and restrictions and a lot of anti-immigration rhetoric would actually get some of India's talent back. India, as we know, is trying to move very fast on the growth trajectory, and they want to become a developed country by 2047. That is what Prime Minister Modi's ambition has been. And to achieve that, India needs a lot more talent. India needs a lot of its people coming back and the current crop staying in the country.
How big are the opportunities at home, Swati? Because when you take a look at the Indian talent overseas, they're heading companies like IBM. You got to wonder how it looks like in comparison in India.
So it's a mixture of it. First of all, the ecosystem has not been built completely. There is no Silicon Valley in India yet. The hope is there, but the government and the industry and all these universities have to work together for a while to make something like that happen. But at the same time, it's not just domestic firms coming up. Most of your global companies have GCCs in India, the Global Capability Centers. And so you have big banks opening their branches in India. You have tech companies which have branches. And a lot of this talent is getting hired within India. So instead of flying out to San Francisco, they're just flying out down south and working in Indian cities, but generating, GDP in India in the services sector. So all of this combined now is growing in India, but it needs a lot more investment in R&D to actually become a sustainable system.
Swati, thank you so much for that. Government reporter in South Asia, Swati Gupta, there for us. Now, just ahead on Insight, Pine Labs CEO Amrish Rao will be joining us to discuss the fintech firm's outlook after its $440 million India IPO, plus a deep dive into crypto markets with Revo Digital and CertiK. Keep it here with us. This is Bloomberg. Welcome Welcome back. You're watching Inside. Asian markets under pressure as we count down to NVIDIA's earnings. That could just tilt sentiment one way or another. In terms of the Indian markets, a reversal that we're seeing gains for Indian benchmark. The Sensex currently up by 0.3%, and the Indian rupee remains steady as we speak, 88.72 versus the USD. And shares of PayPal and MasterCard-backed Pine Labs seeing gains during early trade today. The stock made its trading debut in Mumbai last Friday after raising around $440 million in an IPO that saw strong investor demand. Pine Labs operates across Asia, including Singapore and Malaysia, offering merchant payment systems such as point-of-sale terminals. Let's bring in the CEO, B. Amrish Rao. Amrish, good to have you with us. When you take a look at your valuations, your IPO puts you at about, 2.9, when the private market puts it at 5. What do you make of that gap? Were you disappointed?
First of all, thank you for inviting me to Bloomberg TV. Look, one of the things I have to say is that in terms of Pine Labs, over the last many years, we now have the top 5 banks supporting us. We've got the top 5 e-commerce companies backing us. The top 5 retailers are with us. That never really happens in any market, any industry. So there's a lot of goodwill towards Pine Labs in general. If you actually talk to the startup community in India, you will see that the startup community is most excited about Pine Labs and Pine Labs going to IPO.
But what do you make of the gap, Amrish? How do you read the gap?
At that point, we wanted to price the IPO in such a way that we can absolutely get the community along, get more investors involved in the company. And we actually priced ourselves in that fashion. And that's really what got reflected in the first day and what happened on first day. So I'm not thinking too hard in terms of what the valuation was at the time of the IPO. I really want to ensure that the community supports us and gets to back us as we go into public markets.
Are there implications on your growth trajectory and how you deploy your capital on the back of that?
So what we have identified is that we want to continue to accelerate into global markets. Today, we are present in about 20 countries. 15% of our revenues comes out of global markets. We want to continue to expand, invest heavily as we go into Southeast Asia, Middle East, and also into the African continent. The other piece which we have earmarked is just the technology platforms. We think we've got enough metal in the data center today. However, our transactions are scaling at almost 50% on a year-on-year for the last 3 years. So we do think that we are going to have to invest into technology and also in terms of product capabilities to build out. So that's going to be the use of proceeds coming out of the IPO.
What kind of returns do you think you'll get from those investments, and how soon might that happen?
Look, if you actually look at our financials, we've been able to compound this business at about 20 to 25% over the last 3 years, 5 years, and also even 10 years period. In the last 3 years, what we've done is we've been able to increase our EBITDA margin from high single digits to almost now about 20%. So what we have been able to show is we've been able to show operational efficiency in the business. We've also been able to show good growth in terms of transactions and transaction volumes. If you continue to operate at that level, what we do believe is that we will be able to capture higher portion of the contribution margin down to the EBITDA line. That's the goal that we are working on today.
We know that the payments fintech space is increasingly competitive. What is your competitive edge? What is your strategy to remain in the lead?
That's a great question. The way we look at everything is we look at everything from a checkout standpoint. As you would know as a consumer is, consumers are looking for more and more choices. May that be in terms of how they pay, but also in terms of rewards, cashback, loyalty points. And now we are also getting to see an entire wave which is happening around affordability, where consumers are looking for affordability-based solutions so that they can make a higher ticket purchase. We combine all of these solutions both in the online world and the offline world. There are very few companies who have taken this holistic approach. So that's something that we've done well. The other part which we have done extremely well is we've invested heavily as far as issuing services are concerned, so issuing of prepaid card, gift card, debit card, credit card processing services is something that we've done very well over the last many years. And that's really leading to this growth in our business.
We know that in terms of transactions, you're seeing great growth, good numbers, but in the end, it is about profitability for investors. What kind of targets are you putting, and what are the risks to the numbers that you're projecting?
See, over the last 2 years, what we've been able to show is we've been able to show that we can grow EBITDA at about 70 to 80% on a year-on-year basis. But going forward, the way I would like to think about it is if the company grows as X percent, now out of that X percent, what flows to the contribution profits, and our contribution profits over the last 3 years have been at 75 to 80%, pretty much a large component of that contribution profits should get captured into the EBITDA line. Effectively, what I'm saying is, due to operational efficiency, I have seen an increase in our EBITDA margins, and I don't see that being a one-off. I think it's a secular trend that we should be able to capture.
So you're saying that you can see consistent profit going forward from now?
That's what I'm saying. I'm saying that the way the payments business stacks up is growth is almost guaranteed. If you're delivering good products, you should be able to grow revenues. And we've reached a point where we are showing operational efficiency. So yes, we do believe that this trend which we have delivered till now is not a one-off.
So what are the risks to the business right now, Amrish?
You know, I get asked this question quite a bit. I have to say the way we look at it is risk to the business is really related to how quickly can we bring products into the market, how we go into international markets, and how we deliver value. As I mentioned, we are now present in Australia. We've been in Malaysia for almost 5 years. We've got a big contract going in Philippines. We just launched our initial services in Singapore. Now, what we really want to do is we want to do a quality delivery, make ourselves an household name in those markets. And that's really going to be important because those are going to be some of the growth engines which will deliver alpha in our financials.
You have big name backers, the likes of Temasek, PayPal, MasterCard. They were involved in pre-IPO. How are you looking at governance?
That's a great question again. So we have a really good cap table. Super proud to have Temasek, PayPal, MasterCard, Peak 15 on our cap table. And they've actually been there for long. They've been for more than 5 years on our cap table. What that shows is they feel very comfortable with the governance, the quality of the management team that we've built, our abilities to show consistency in our performance. And I really think that all signs from these investors have been very good till now. In many cases, they've also been helpful in opening up doors, opening up new markets for us. So we really appreciate them backing us for so many years.
I guess the question really is, how do you guard against decisions that actually benefit your big backers more compared to the other shareholders?
That's not how it's been working in our company. And now going forward, we've got a very strong independent board on board. So we've got folks from the telecom industry, banking and financial services, and also from the regulator. So we've actually built a fairly strong board and leadership on our side. So this will be a very well management and board-led company. And to be clear, that's exactly how our investors have allowed us to operate even when we were in private markets.
I want to talk about your expansion plans in terms of acquisitions. We know that you bought C2 back in 2023 to help cross-border transactions. Are there other plans in the next 12, 24 months to make further M&As?
So we have identified one of the use of proceeds out of the IPO is largely to do M&A, and those M&As I would tend to think would be more from a product-led and more for creating new capabilities in the business. What you'll not get to see from Pine Labs is making acquisitions to beef up the financials of the company. We think fintech is in an ever transition. We are going through significant changes globally globally, and we need to build products. In many cases, you've got to partner for new products, or we need to make acquisitions. So we will look for technology gaps, and we would look to fill up those gaps through these M&A action.
Where are you looking? Which markets in particular, and how many of these acquisitions might you make in the next 12 to 24 months?
I don't have a date right now, and I know this is a great way to evade the question, but I truly don't have a date. I don't have a target in place. As I told you, I do have a framework that we've worked through in terms of how we look at M&A. We've made very successful M&As over the last 5-7 years' time. We think that that's a very important component, but we don't have a target in place.
We know that you're one of the few customers, or rather companies, already serving customers overseas. In terms of ratio of domestic international customers, how might that look like in the next few years?
So we are getting to see about 15% of our revenues currently coming out of international markets. International markets are growing at about 50% on a year-on-year basis, while the overall company has been growing between 20 to 25%. So what I do see is if that trend continues, the percentage of international revenues will rise up significantly over the next few years. And that's good, because the way it is, Indian fintech has been developed and has been growing for the last 4 or 5 years. Many of the markets are looking to India to take inspiration for bringing some of the solutions back into those countries. We think we are one of those companies which have built a transportable technology platform, and we can take it to other markets.
Amrish, thank you so much for joining us. Amrish Rao, CEO at Pine Labs. Now, Google's investment in the Indian state of Andhra Pradesh is expected to grow beyond its initial $15 billion over 5 years as more global firms flock to India to build data centers. Chief Minister Chandrababu Naidu spoke with us about his state's tech ambitions, including in quantum computing.
The economy of India is matured, and funds are available all over the world. We need people to transform. Technologies are matured. I have seen IT. To promote IT, I started iTech City. That is late 90s story. Today you are seeing AI, data center, and quantum computers. Leapfrog development. And also, Government of India wanted to go in a big way, technology breakthroughs. Government of India announced quantum machine. I took an advantage. First quantum computer is coming to Amravati. After that, I called people. What is our next goal? Within 2 years, we are going to produce quantum computers. There, we are going to export it. Now we are focusing on green energy. Today in Visakhapatnam and Andhra Pradesh, it is going to become global hub for data centers. How it happened? It is an ecosystem. If you create something, automatically something will come. Because of our tariff, cost-effective power, and also green energy, people are coming to India to set up data centers.
Google has announced a $15 billion investment. You expect them to do even more, maybe double that?
It is a win-win situation. To start with $15 billion within 5 years' time. Then we are having human resources also to work AI. Now we are very strong in information technology. Now we are changing our gear for AI. Tomorrow we are going to change again quantum computers. This is where everybody is saying America is having Silicon Valley. We are having Quantum Valley.
Quantum Valley.
We want to speed it up, everything quantum speed, thinking process, everything. Tomorrow, if you can imagine quantum computing, personal medicine, agriculture at micro level, decision at micro level, communication at micro level, Tomorrow, all offices will become, corporate offices will become redundant. Reason is, data center will compute everything, keep everything, communicate everything.
You're building a new city from the ground up, Amaravati. How soon can we expect that to be functional?
Amaravati is a greenfield city. It is a wonderful project. Hyderabad was brownfield city. 2 cities, I added 1 more city. Today, best livable city is Hyderabad. Highest per capita income is Telangana. You name that outer ring road, any city is having, you can go through now. No other city is having. Greenery, IT, pharma, insurance, biotechnology, airport, widening of roads, everything we had done. Today here, this is greenfield city. I want to go to the next level.
And that was the Chief Minister of Andhra Pradesh speaking with Bloomberg's Den 10 Kate. We have Geely out with third quarter numbers. Net income jumping 59% from a year ago. Its sales rising 27% year on year. It's pretty much a beat. Geely, of course, behind the cars, including Zeekr, Livent, and Lynk & Co. It's done really well for the third quarter, beating estimates. Net income coming in at 3.82 billion yuan. That is a 60% upside year on year. Now, still to come, Bitcoin has come crashing back, wiping out most of the gains it had wrecked up this year. We'll discuss the outlook for cryptocurrencies as broader markets turn cautious. Zann Kwan, Managing Partner and CIO at Revo Digital, will be joining us along with CertiK's Head of Capital Markets, Esme Powell. Keep it here with us. This is Bloomberg. Well, China is escalating its confrontation with Japan over Prime Minister Sanae Takaichi's comments on Taiwan. Chinese state media is threatening major countermeasures after Beijing's travel warnings raised the possibility of economic retribution. Bloomberg Intelligence says retailers may be hit if the tensions result in boycotts. Let's bring in senior analyst Catherine Lim. And Kat, we're seeing a sell-off already in retail sales today, especially in Japan. How bad can this get for the retailers?
Well, there are definitely some Japanese retailers that's more exposed to Chinese tourists and, specifically the tourists from mainland China. And we're really talking about Shiseido right here. We know the Chinese, tourists loved for premium products itself. And Shiseido is the largest cosmetics company in Japan. And it's always the go-to in Japan, not just at the department stores, but also the drugstores as well. So that is where, the reach of Shiseido has actually gone to. So they are, based on our calculations itself, one of the retailers that will likely be hit the hardest if this tension continues to, prolong into 2026 and particularly into the Lunar New Year holidays.
You talk about Shiseido. When it comes to its margins, it does seem like it needs more from outside of Asia. What is the strategy that the company is adopting right now?
Right. The company is looking to actually revamp some of its lower performing brands. We're really talking about Drunk Elephant, which is essentially a good product if you ask me. It's just the positioning of which, the marketing of which, it's probably something that a company has to relook at their marketing strategy and position it in the new environment, or rather a more foreign environment like the Americas or even Europe for that matter. So I think going forward, they were optimistic, or they are optimistic about 2026 with revamps not just for the Americas but also China. And in the latest results itself, we've actually seen some of the upticks in China onshore performance coming through. Now, whether this tension is going to result in boycotts, Haslinda, as you've actually mentioned, something that I'm keeping my fingers crossed that it doesn't go in that direction, but never say never. We've actually seen how many of the foreign brands have actually suffered as a result of tensions and, issues that didn't go down very well with the netizens.
Catherine, we're also watching declines in Alibaba in Hong Kong today after an FT report on the company's possible ties to the Chinese military. What are the implications for Alibaba here?
Right, that's a tricky one because, if we essentially look at whether it's Alibaba, Huawei, Xiaomi, I think by and far most would not disagree that they do actually have some links to the government. I mean, they are Chinese companies, of that origins after all. I'm lesser concerned about that because, the company, it's still making inroads when it comes to deals, striking on the cloud deals, e-commerce side of things with other countries as well. But, we'll have to actually see whether there is more concrete evidence of that and whether that actually really affects its business.
You got to wonder what strategy it plans to adopt right now amidst such allegations.
Right. Looking forward to the company addressing it next Tuesday, November 25th, when it actually reports its results for sure. But again, speaking to the company on multiple occasions itself, this is not something that has actually come out new. It has surfaced before about their ties, and there were concerns on multiple fronts depending on the environment that we're in. So I do think that, Alibaba will continue to do what they have set out to do and what they've actually committed to, in the last 9 months of 2025. They're probably going to actually share more insights onto, how works on not just the cloud, but on their e-commerce side, particularly quick commerce, which is something that they have sunk in the profits to actually grow in China this year is doing. So look out for that next Tuesday.
Catherine, thank you so much for that. Bloomberg Intelligence senior analyst Catherine Lim. Now to the top global stories we're following. India has arrested a Kashmiri man, accusing him of helping plan last week's suicide bombing in New Delhi that killed 10 people and injured 32. Authorities say he helped buy the car used in the attack. Indian investigators say they are still working to uncover the wider network behind the bombing, which has raised security tensions for the Modi government. German Finance Minister Lars Klingbeil is heading to Asia, pushing for open, rules-based trade as tensions rise between the U.S., China and Europe. He'll take part in the German-Chinese financial dialogue in Beijing, meet officials in Shanghai and Singapore, and press for fair competition, along with better market access for German firms. And Thailand says tariff talks with the U.S. will continue separately from its commitments to President Trump over the border dispute with Cambodia. Bangkok clarified the stance after Prime Minister Anutin spoke with Trump, who signaled the U.S. doesn't wish to interfere in the conflict. The U.S. had paused trade talks pending Thai compliance with a peace deal. And coming up, Japan's economy contracting for the first time in more than a year. We'll dig into the numbers and the growing case for possible stimulus. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. We're keeping an eye on Japan's industrial production for September. Of course, we've seen how Japan's GDP has been sliding, and a weaker number would perhaps build the case for Prime Minister Teiichi to have more stimulus in the economy. Japan's falling GDP backing Teiichi's push for that big fiscal stimulus. In terms of the numbers coming out of Japan, the final September industrial output rising 2.6% month on month. Now, the latest industrial production revisions come after data early today showed that GDP contraction for the first time in 6 quarters, helping Prime Minister Tsunai Takaichi's case for an ambitious stimulus package that appears at odds with the BOJ's own plans for a rate hike in the coming months. Well, Bloomberg economy and government editor Paul Jackson joins us now. Paul, what do you make of the numbers?
Well, these aren't great numbers. A contraction is not what you want, but there is a bit of distortion in play, and the figure was actually not as weak as was feared. We've got a number of factors in play here. One is the pullback in exports, which is related to Donald Trump's tariffs. There was a lot of bringing forward of exports in the previous quarter, so we kind of always knew there was going to be a pullback on the trade figures. So that's one factor. Another large factor in this morning's figures is coming from the housing market. Some environmental regulation in the spring led to a surge in house purchases earlier in the year, and again we're seeing a sharp pullback. We saw spending on property falling by a third in the quarter in the latest figures in annualized terms. And I think that the backdrop to all of this is with these factors dragging on the economy, consumption was almost flat as households continue to struggle to ramp up spending in real terms in this new world of inflation that Japan is experiencing. And this is one of the main bugbears of voters, and that's why the Prime Minister is formulating an economic package. We're expecting that later in the week, and from the perspective of Prime Minister Teiichi, this is kind of a helpful figure, because if you want to release a big economic package, it's nice to have a contraction in the economy ahead. When I say nice, that's in kind of relative political terms.
When you take a look at Japan's economy, it's been a tale of two halves, a solid first half and perhaps lackluster second. What is the outlook, whether or not we get that big bang stimulus from the government?
Well, it remains to be seen, how much this can boost consumption at home and how long. I mean, we talk about subsidies being doubled for electricity and natural gas supplies for households in the coming months. That's what's out there in local media. That's kind of in line with expectations. So that could give consumption a bit of a bump. I would imagine that the trade figures are going to improve a little bit as things stabilize after the front loading and then pullback stabilizes. Obviously, the longer impact on global trade and the economy from those tariffs is yet to be seen. Surely it can't be much of a positive. So there are strains on the economy going forward. But essentially, I don't think we need to ring the alarm bells here. It is the first contraction in 6 months, but I would be expecting the economy to pick up in this quarter.
And business sentiment has been robust. That will provide some support for the economy.
Yeah, absolutely. I think the biggest surprise actually in today's figures was how the capital spending by firms was much stronger than expected. Economists were expecting this to fall in the quarter. However, we also must be wary that these GDP figures out of Japan do get heavily revised multiple times. And that capital spending figure is one of the kind of weaker figures in the preliminary data, the one most subject to revisions going forward. So we'll keep an eye on that. But looking at that figure in isolation would suggest that firms still relatively optimistic about the future, despite all the uncertainty that's out there.
Paul Jackson, always good to have you with us, economy and government editor there, Paul Jackson in Tokyo. Now, once known primarily for its photography business, Fujifilm is expanding into biotechnology and semiconductors with major projects in India and other countries. Speaking exclusively to Bloomberg, CEO Teiichi Goto told us more about the company's new goals and the impact of tariffs.
Currently, the primary areas we're investing in are, first, contract manufacturing for the biopharmaceutical business, also known as CDMO. The other area is semiconductor materials. These two markets have exceptionally strong growth potential. For example, the CDMO business currently represents a $500 billion market size. While low molecular weight drugs are currently dominant, the market is expected to grow to the point where biopharmaceuticals will surpass them by 2028. As for the semiconductor market, it has been growing at an annual rate of around 8% or 9%. By 2030, it is projected to reach a scale of around $1 trillion. We are investing in both of these areas.
Looking at the broader Fujifilm business, what's been the impact so far, especially given that we're not just talking about levies, we're also talking about potentially costs going up when it comes to some of the materials that need to go into a lot of the components of the things that you make?
That's certainly true. The tariff issue was indeed a major problem for us initially, but now at an incredible speed, we've changed the supply chain. We ship from the country of origin that supports us. Then we also worked on cost reduction, cutting expenses, and lowering product costs. Additionally, we introduced new high-value added products. As a result, the impact of tariffs has been minimized, and its effect has largely disappeared. I was a bit concerned about our consumer products, like the mirrorless digital cameras, the Instax line popular with younger people. I was worried that consumer sentiment might be dipping a bit. And also, given the situation in the U.S. economy, now we're nearing Black Friday and the peak Christmas shopping season. Looking at the current state of distribution and purchasing, it seems things are still going strong. So I'm feeling a bit relieved. Therefore, regarding this fiscal year's performance, specifically in the imaging division for digital cameras and Instax, we have revised our forecast upward by 20 billion yen.
Fujifilm CEO Teiichi Goto speaking to Bloomberg's Sherry-On in Tokyo. Now coming up, Bitcoin recovers some ground after hitting its lowest price this year. As the crypto bear market deepens, we'll take a deep dive into digital currencies next with Revo, Digital Family Office, and CertiK. Keep it here with us. This is Bloomberg. All right, a check on cryptocurrencies. Bitcoin briefly falling below $93,714 to erase a more than 30% gain this year. It peaked, of course, at the record of more than 126,000 in October. Bitcoin, Ether, Solana in positive territory as we speak right now. Institutional buyers pulling back after that Bitcoin tumble. Let's get perspective from Zann, Kwan, Managing Partner and CIO at Revo Capital Family Office. Also with us, Esme, Head of Capital Markets and Strategic Intelligence at CertiK. Good to have you both with us. Zann, let's start with you. What do you make of this, well, some say unraveling of cryptocurrencies?
Sure. If you look at what's happening in the data side, Bitcoin has just appreciated actually less than 5% this year on year, or since January, just slightly under 3%. And however, a lot of times you look at why do institutions get into Bitcoin or allocate into Bitcoin is to really deal with the debasement risk. So on the US dollar side, it has depreciated 9% this year. So in terms of that, -9 plus 3, so you are thinking if you are allocating into Bitcoin, you have allocated, even though in the backdrop of a weak market, you are already 12% up in that sense. So I think with that, and you have seen DAT, Digital Asset Treasury, building up, accumulating digital asset on their balance sheet, and also more institutions, including family office, allocating or rotating some from gold and some of the other asset classes into digital assets.
Esme, why the sell-off in the first place? It is a confluence of factors, right? Including, a revision of expectations of the Fed cuts.
Right, you're absolutely right. So what we're seeing in the market is that the investors are basically questioning whether they should be recalibrating expectations. So just going back to the October 11th and 12th pullback, so we can see that it's causing a vicious cycle of deleveraging and also liquidity air pocket. So for example, what we're seeing right now is that people are taking risk off away from risky tech equities and AI proxies and away from crypto assets and into safe haven assets, for example, gold. So what I see from here is I expect there to be a continuous recalibration as investors take profit from the year-to-date October rally, and also for them to shift to more safe haven assets.
Well, why haven't cryptocurrencies recovered fully from that October crash? When you take a look at, the equity markets, for instance, they've continued to test new highs.
Well, that's essentially the different ways in which the equity markets and traditional capital markets trade compared to crypto. So, for example, crypto, there's a lot of macro linkages. So even when Trump announces a 100% tariff, that releases a shock that would cause a dominoes effect, and that essentially leads to a liquidity squeeze in which market makers and also exchanges have more wider spreads, and also them pulling out liquidity from the markets. As a result, we see a lot of thinning of price movements, and also for a lot of forced selling. And that's causing a dominoes effect throughout the market.
Is there extreme fear in the crypto space then? I mean, we're talking about massive movements.
Sure. I think right now, if you look at the extreme fear greed index, is at 10, which means it's an extreme fear. But if you look at what happened on October 10, you're talking about $1 trillion, 350 billion drop in market and 19 billion in a day liquidated. So with that, I think the market is still recovering from the scars of the 10-10 sell-off. But having said that, if you look at not just on Bitcoin, there are other segments in the digital asset themes that are actually doing not too bad, relatively actually gaining grounds this few days as some of the within the market, they are shifting away from some of the majors to other digital assets.
We're talking about a pullback at a time when there's so much optimism about President Trump's digital approach and regulation, yet this massive move downwards. How do you square that?
Okay, I think one is the correlation with the Max 7. If you look at the Max 7 correlation and Bitcoin, it is very correlated right now. However, so if you ask me, is there overselling this time in the short term? I believe there is. If you look at the technical analysis on that front and the macro side remains strong, right? We talk about a debasement risk, buying Bitcoin, allocating Bitcoin to deal with that risk. And I think now on the Clarity Act, which is going to sign into law, that itself will remove uncertainty. And what happened during the government shutdown is you're talking about 41 days of no data. I think that itself spoke the market. But having said that, we are, in terms of the next few months and quarter, we believe that Bitcoin will recover.
In terms of the correlation between Bitcoin, cryptocurrencies, and Max 7, Esme, what are your own expectations? Because, when you take a look at the Max 7, some say that we're going to continue to see a correction in the market.
Right. So in terms of the correlation between risky assets, for example, crypto and also equity, so I believe that the fellow interviewer has already very clearly expressed the correlation. So what I'm expecting going forward is that there needs to be market structure change, and I think right now global policymakers has already been working on that. So for example, the FCA and also Bank of England has put out a joint consultation regarding stable coins. So I believe that looking forward to next year. So we're going to see strength around the ecosystem and also the infrastructure plays. So I'm positive in terms of infrastructure, custody, and also ETFs, new investment products, anything that's along the lines of regulation. And the second part to that is that with institutional capital flowing in with clearer guidelines, so I believe that the market is going to trade closer to fundamentals and also less mispricing and less reaction to X and also Twitter headlines.
But it's still going to be contingent on Fed moves. If the Fed fails to cut in December, we can expect that correction in the crypto space to continue. Is that a fair assumption?
Yes, I believe so. At the same time, I think there's going to be some looks.
Go ahead, Esme.
Yeah, at the same time, I think the market will be looking for two data points, which will be the litmus test as to whether it's going to be a prolonged sell-off or rather it's a recalibration of expectations short term. So number one will be around the empirical data around data books, order books, and also around data funding rates of exchanges. So that's going to be a testimony of the liquidity that's out there. And the second is related to pricing. So how wide the spreads are around the exchange rates will be a second factor that's going to influence the market.
And Zann?
I think I want to focus on Clarity Act, which will be coming into play. I think with that, we know that in the market, crypto exchanges market, the Wall Street could contribute from anything from 30 to 70%. So when regulation come out, we're going to, in a way, fix that, and that itself will remove some market manipulation and some of those market moves that will, in that sense, be not so volatile going forward. And a lot of price movement, if you look at for the past few months, a few weeks, cannot be explained to what are the strong macro underlying currents or the tailwinds behind digital assets, particularly Bitcoin. So with that, with I think the regulatory clarity coming out, that we think that will actually move the market, the entire market, into positive zone.
So you're saying less volatility can be expected once that happens, and will that encourage even more institutional interest in cryptocurrencies?
I think in 2025, we've already seen a lot of institutional interest at the sideline. I think a lot of family offices and also even listed company looking at allocating. So they are, in a way, getting ready. I think 2025 is the year of observation and getting ready. So I think 2026 is we will continue to see inflow, strong institutional inflow into the market.
So how big in terms of the holdings in a portfolio, for instance? What are you seeing? How much are people holding cryptocurrencies in the portfolio?
Sure. I think last year on the show, we talked about as much as 10%. I think there are some families and some institutions and, as I said, private company and listed co are allocating anything, I would say, that I've seen, or either from thinking we're allocating to a few percentage below 5 to all the way double digit.
And what's your take on that, Esme?
Right. So I'd like to quote from my conversations with the asset managers, for example, the largest holders and also the issuers of ETFs and also digital asset treasuries, as well as with stablecoin issuance and distribution. And then what I'm hearing is that obviously in the past market cycles, we've had multiple instances in which there were crying wolves, and then that didn't really materialize in terms of institutional inflows. But why I believe that next year is going to be different is because you can see that, number one, as Zann rightfully mentioned, so there's been a softening and also a warming up in stance when it comes to the U.S. and other also global jurisdictions. So that's number one. And number two is that in the back of tokenization, RWA, and also stable coins, so you can see that that's going to drive a lot more institutional inflow. Just quoting from a statistics, so looking forward to the next 4 years, so stablecoins liquidity is going to be 50% dominated by institutions as a prediction, as opposed to 5 to 10% right now.
So we're potentially looking at a bull market ahead. I mean, it is a divided world. Some say we're actually looking at the start of a bear market. How do you start thinking about the crypto cycle? How do you make sense of it?
Right, so as we know, the crypto cycle is normally 4 years, and then next year would be the routine start of the bear market. But what I believe is that next year we're going to see a tighter hug around institutionalization. So that's going to lead to market structure change, which I do emphasize. For example, regulations, that's going to distort the regular bull-bear cycle, and now we're going to see fundamentals kicking in. So therefore, I reiterate my stance on being positive around infrastructure, and also those who are we're really seeing real use cases and also user activity, institutional activity, and also regulatory blessing.
So Zann, bull or bear, and when do you buy the dip?
Okay, so I think one thing that is stopping some of the flow coming in is the uncertainty around counterparty risk. I think when the families and institutions are doing due diligence on that front, that is what stopped them, because they don't know what to ask and couldn't see through what ultimately the counterparty risk is. I think with, again, the clarity in terms of regulation, that will reduce the counterparty risk, and which will also increase confidence. So in fact, when we talk about the 4-year cycle, the bull and the bear market seem to be lengthened. So the question is that, is there still a 4-year cycle? I think with that, coupled with what's going on the regulatory front and the macro scene, we are still bullish in the mid to long term. But I guess in the short term, there will be volatility until all this regulation settle in, as institutions also get comfortable in allocation and understand what to do behind the due diligence.
Are there factors that investors are not paying enough attention to?
Yes, that means that not all eyes on Bitcoin and some on Solana, but there are fragments of the digital asset on liquid tokens that could be bullish in the next quarter or the next year.
Such as?
Such as, for example, the privacy token segment.
And how high can they go?
Some people deem that as like what I call it the new Bitcoin, all had different use cases, what Bitcoin couldn't do. I think with that, one of the questions to ask on the OGs, on the digital asset source of wealth, where are they going to park their money? I think that is one question. If we could answer that, we could know or where to see where the bear market or the bull market is.
And Esme, in terms of where you should be parking your money in the crypto space, what are the best bets right now?
Right now, I would believe it's stablecoin issuers and also some private companies that are on the verge of IPO. So I'll be looking out for exchanges, custodians, and also tokenization platforms. So I'll primarily be looking at the intersection between traditional capital markets, equities, as well as with digital assets. I think that is the area to play for institutional money in the next 2-3 years.
One last question to both of you. Where will Bitcoin end the year? Esme?
I would say 12K, 120K.
120K.
Okay, I put the line between Chinese New Year and the New Year. I think between 140 to 150.
All right. Projections we will be watching. Zann Kwan, Managing Partner and CIO at Revo Digital Family Office, and Esme Pao, Head of Capital Markets and Strategic Intelligence at CertiK. This is how it's looking for Asian benchmarks under pressure as we count down to, of course, the earnings of NVIDIA that could point the way to sentiment in the market. The MSCI Asia Pac Index down about 0.1%. The Nifty Index inching upwards, up by 0.2%. Of course, the Nikkei under pressure from that spat between Japan as well as China. Now, before we go, here's a look at our guests for tomorrow. We'll be getting the outlook for global markets with Lefa Tengler Investments. Plus, we'll be talking investment strategy with VP Bank's Felix Brill. Catch those interviews at the times on your screen. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.